Before I get started, guys, let me introduce myself. My name is Dion Beg, and I'm a mortgage specialist based out of Ontario. I'm here because Mary has kindly invited me to come and speak with you, and she's explained that there's many people out there who she works with who may be interested in learning more about buying their first home. And so today, most of what I'm going to talk about will be the steps you need to take towards buying your first property. But I want to also let you know that our company also specializes in helping people buy their second, third, or fourth properties. And many of our clients have real estate investment portfolios, of 5 or 10 properties. So for today, I'm going to focus on the first-time home buyer requirements. I will tell you, though, if you are already a homeowner and you're considering buying another property, a rental property, or a cottage, a lot of what I'm going to cover in the first-time buyer section will actually relate to you. I'm going to try and wrap this up in about 30 minutes, and then at the end of it, if any of you have any questions, if you could just sort of hold on to your questions until the very end, and then we can have a bit of an interaction. Is a presentation that I call The Keys to Your First Home. And what I'll be covering are the major criteria that most banks look for when looking to lend money to you or to anybody. And it really comes down to 3 main criteria, and that is your credit score, as well as your credit history, as well as your debt load. Okay. When it comes to income, obviously it comes down to your annual income. And number 3, your down payment and your closing costs. So if you imagine these 3 key criteria are the things that we need to help the bank satisfy, I'm going to dive in a little deeper into each of these 3 categories now. So in terms of credit history and your debt load, as you're probably aware, each of us have a credit score. And that score can range anywhere from 300 points to 900 points. Most lenders are looking for scores ideally above 680. So 680 is kind of like this magical score where they often give you access to the maximum amount of money to borrow and potentially more preferable interest rates. Now, can you get a mortgage with a credit score below 680? Yes, you can. But if it's below 620, I can tell you it changes things dramatically. So in terms of how to build your credit score, let's talk about the types of credit. So there are different types of credit. So firstly, let me say this. A lot of people think that by not having a credit card, that's a good thing. And unfortunately, that's a misunderstanding of the way that things work in Canada. It's actually really important to demonstrate to the lender before you go for a mortgage that you can manage smaller debt. And the way that most of us prove that and build credit is by using things such as credit cards, lines of credit, or even vehicle loans. I can tell you that a lot of people also think that their student loan may mean that they have a debt which reports and produces a score. I can tell you that unfortunately a student loan doesn't create a score in the same way that consumer debt would. And when I say consumer debt, I mean credit cards, personal lines of credit, or vehicle loans. So if you just have a student loan, I'm going to tell you now it's not enough. You're going to need to build credit using a credit card or all those other things. And it doesn't have to be a huge credit limit. You don't have to have a $20,000 credit card. But what is important in regards to the credit card is making sure ideally that you're not approaching the limit and hopefully never exceeding the limit. So let's use a simple number of $5,000. Let's say you have a credit card, the limit is $5,000. And if you're at let's say you've used $4,900 of your $5,000 limit. So I can tell you that will actually hurt your credit score. It's actually important to demonstrate that you have access to credit, but you don't necessarily need access to all of it. And so I can tell you that I've had clients who come to me in that situation where they had a credit card with a $5,000 limit with a $4,900 utilization, and their credit score was quite low. And we coached them and we explained, look, for the next month or two, let's try and limit your use on the card to maybe $2,000 or $3,000. Okay, and in doing that, in that very small change of behavior, their credit score boosted, and because of that, they were up above that 680 number, and they were able to qualify for those slightly better interest rates. Okay, so in terms of how many types of credit facilities to have, I'd recommend you get at least 2 or potentially 3. So hopefully those of you listening have at least 1 or 2 credit cards, in which case if you have 2, you're fine. If you don't have 2 credit cards, I recommend you go out and get yourself another 1 or 2. I myself have multiple credit cards, most of which just sit in my drawer near my bed. I only really use 2, but I have several more. Now, the reason it's better to have a few more is that if for whatever reason something bad happens on one credit card, then maybe you have 3 or 4 others that show that, look, these ones are managing okay, and that one was just an anomaly. Something crazy happened that month, maybe an emergency or something where you went over limit or you maybe missed a payment. Ideally, none of those things happen. But if you only have one credit card, then that one credit card, that represents 100% of your credit history. And so if you damage that, then you've damaged your entire credit history. Whereas if you had a couple more reporting well, it wouldn't hurt you as necessarily as much. And so ultimately what I need you to leave this segment of this presentation knowing is that credit is important, and some credit and some debt is actually a good thing. Okay. Now, so some debt is not great. And what I mean by that is if you're carrying continual balances on your credit cards of say $3,000 a month, and this is more of a credit counseling and budgeting issue more than a mortgage issue. If you're carrying $3,000 a month continuously, I can tell you that that's going to effectively be being charged at generally a fairly high interest rate. Credit cards are anywhere from 10 to 20% interest rates. And so it's in your interest to ideally not carry credit, because you're going to be ending up paying significant amounts of interest on that by the end of the year. And so for that reason, in a perfect world, if you can use your credit, but then pay it down to 0, and then of course use it again, it's important to continue to use it. But I don't necessarily think it's a great idea to continuously carry debt on your credit cards. Okay, so that's credit history, guys. Let me now jump over to the next point, which is income. Now, I know that I'm talking to a room full of healthcare workers right now, and so most of you are employees. Some of you maybe have a partner who is self-employed, and we'll cover that as well. But for employees, for those employees listening, we need to prove your income to a lender. And let's say you're a full-time employee, full-time permanent. Well, that's very simple. We'll just look at your regular pay stubs. If you happen, let's say your regular pay is $60,000 a year. But let's say in your position, you work a lot of overtime. And usually you, in addition to your 60, you earn another 10 to make $70,000 a year. If it is in fact, say 70,000, we can use 70. The way we prove that though, is they want to see 2 years of T4 annual income statements that show that for the last 2 years, you did make $70,000 a year. If we don't have that 2-year history, then ultimately they're just going to go off your base pay. In this case, in this example, it might be $60,000. And the way we prove that is by pay stubs, job letters, and then maybe the T4 statements if we're going to use that average. Some of you listening may be part-time or casual employees. We can use that income as well, but with part-time or casual, they will always look at the 2-year average. So for a full-time person, just the pay stub will usually be enough. Pay stub and job letter is enough. For somebody who is casual or a part-timer, they're going to look back at the historical 2-year average. Okay, and I know that a lot of people in healthcare may be casual or part-time, so that's going to relate to some of you listening, I'm sure. Now, if let's say you got somebody, or somebody listening might get a bonus or a commission, bonus or commission. Again, it goes back to the T4 average. If you or somebody that may be partnering up with you to buy is self-employed, it's slightly different. So if you're self-employed, you work for yourself, or if you're working for your family's business and effectively it's sort of all self-employed, they're going to look for definitely that historical number So it'll be the averages for the last couple of years. They're going to want to see your notice of assessments and as well as your tax returns, your actual T1 general tax returns. So that pretty much covers most people: self-employed full-time, self-employed part-time, employed part-time, employed full-time or casual, and self-employed. Now, this last point here I put up as a quick rule of thumb. A quick rule of thumb to figure out how much money can I borrow based on my income. The rule of thumb there is you can usually borrow somewhere between 4 and 5 times your income. Okay, so using round numbers, if you're making a household income of $100,000, then depending on the lender, depending on your down payment, generally speaking, we could probably borrow or aim for a purchase price of $400,000 to say $500,000, something in that range. And I know that, say 5 years ago, that was a very straightforward thing to purchase. Those types of properties were quite available. In today's world, I know prices are extraordinarily higher than what they were 5 or 6 years ago. And so even a household income of $100,000, you may find it challenging to buy your first home. And to that end, I'll tell you that for the last couple of years, almost every first-time buyer that we have helped has had to get the assistance of somebody else. And in most cases, that somebody else was a family member, in most cases, parents. So let's say we had a young couple who between them made $100,000, but their parents may come on to the mortgage, and the parents also make $100,000. So now we've got $200,000, and potentially now we can push that purchase price from say $500,000 up to $1 million. So just keep that in mind, that if you think that your income might be a limitation, that there is nothing stopping you partnering with others. I've also seen sort of, brothers and sisters partner up, or even friends who know that by themselves they can't really buy a property, but together they can buy a property that could accommodate, both of their families. So those are things that are possible, and we have put those types of deals together as well. Okay. Now, the next point here is down payment and closing costs. So as you might be aware, we can't just buy a property with zero down payment. That used to be the case many years ago. But if you're buying a principal residence, and it doesn't matter if it's your first home or your 10th home, if you're buying your principal residence, a home that you're going to live in, technically you can buy that property with only 5% down payment. Okay, so if I was to use that number, $500,000 purchase price as an example, then 5% of that number would be $25,000, and that would be enough to act as down payment on a property, as long as your income qualified for the mortgage. Now, in terms of that down payment, I also just want to point out that when we're putting down anything less than 20%, your deal is what we call insured. And what that means is the bank will lend you the money as long as the government or a different type of insurance company guarantees the lender that in the event that you, the borrower, miss a payment or default, a default on your mortgage, that the government will actually pay the bank for their loss. Okay, this is a program that was developed many years ago by the Canadian government to help first-time buyers enter the real estate market. Many years ago, in order to enter the real estate market as a home buyer, you had to have at least 20% down. And many people found it hard to save 20% down, as I'm sure you can imagine. So they created this program, 5% down, but the banks have the backing of the government in that, okay, if for whatever reason the bank has to take back the property and sell it because you defaulted on your mortgage and they can't recover their money, well then the government or the insurance company will cover it. So at 5% down, 10% down, 15% down, all of those deals would need to be insured in the back end. So and the thing is, with these types of deals too, the amount of down payment depends on the price. So if you're taking notes, this is one note you'll want to take. If you're buying for $500,000 or less, then 5% down is okay. Let's just say you wanted to buy for $600,000. Okay, so this is where things change a little. On the first $500,000 of the price, you can put 5% down, which is $25,000. But anything above $500,000 on the purchase price, in this case, we have $100,000 more than 500,000. In this case, that extra 100,000 in price, we need to put down 10% of that amount, being $10,000. So we put down 25 grand plus 10 grand. We need to put down $35,000 in this example. So just keep that in mind. If you're buying for above 500,000, it won't be exactly 5% you put down. It'll be a little bit more than 5% on the overall purchase price. Now, in terms of how to get access to the down payment, well, of course, there's multiple ways. One way is through using your personal savings. Another is by using your RRSPs. You can actually use your RRSPs to save for a down payment. So I'll give you a quick example. If you make $100 at work and you take that as income, well, you'll pay tax on that $100,000. Let's say you pay $30 tax and you end up with $70. And that $70, well, you can save that $70 for your down payment. So that's option number one. Option number two is, instead of taking the $100 from your employer personally, you can tell your employer to direct that money into your RRSP. And what happens is the entire $100 lands in your RRSP. So if you took it as income, you'd only have $70. If you direct it to your RRSP, you'd actually still have the $100. So if you look at it that way, it's like getting more than a 30% return on your money straight away by just telling your employer to put that money into your RRSP. You can actually withdraw money from your RRSP for down payment. So if you have the choice to save $10,000 in cash savings or $10,000 in RRSP, then the RRSP is a much better way to do that, because you're going to reach your $10,000 goal much faster. The limit that you can save per person in RRSPs is $35,000 for the purpose of down payment on your first home. And so if you're married, for example, then between the two of you, you could save $35,000 each, which would be $70,000, and you can redraw that money from your RRSP for the use for down payment. You are required to pay that back, but you have 15 years to pay that back, which will likely happen just through your regular RRSP contributions as you continue to work anyway. So this is probably by far the best way to save for your down payment. The last way here is gifts from immediate family. This is very common. In many cases, parents or siblings help each other. And just keep in mind here that the banks generally want that gift, if it's a gift, to be from an immediate family member. So it can't be from some distant cousin. Generally speaking, it's parents or grandparents or immediate siblings. Okay. All right, so that's down payment. Oh yes, and documentation. I will tell you that documentation is going to be, I guess, a bit of a tedious part of the process. I'm happy to say that, you know, in our brokerage, we understand what each lender is going to need, and we like providing our clients with a checklist of all the items that we would need in order to set up their file properly. And it might take you 30 minutes or an hour to pull this stuff together, but once it's put together, you know, it makes it much easier for us to come back to you with numbers in terms of what's approved and these types of things. And as mentioned earlier, you know, it'll be things like pay stubs or job letters or historical T4 statements or T1 general statements. But again, we're here to help you through that process. I mentioned earlier this mortgage insurance. I just want to clarify this big point because it's a point of confusion for a lot of people. Mortgage insurance is not life insurance, okay? So I'll clarify the wording here. That mortgage insurance, which allows you to borrow money even if you're only putting down 5% or 10%, that's what they call default mortgage insurance. In the event that you default, that mortgage insurance pays the bank. It doesn't pay you, okay? There's a different type of insurance which can sort of help you if and when, let's say a couple was married, they passed, let's say the husband passed and died, and there's a type of insurance which can pay off your mortgage in the event of, say, the passing of your spouse. That's more like a life insurance type of insurance. So I just want to clarify that just be careful at the time of buying, assuming that you've got insurance which pays out the mortgage in the event of death. You really need to talk to your advisor and clarify what kind of insurance you're getting. You might end up having to get both, right? And totally separate to these things is, of course, the building insurance on the property you're going to buy, but that's a different category again. Okay. Now, when we engage with anybody who's interested in working out whether they can buy, what we do is we collect those documents and then we'll come back to them with what we call a pre-approval. So let's just say you send in your documents, we run the numbers, credit's good, your debt load's not so bad, and you've got good income. And so we might come back to you with a number of, say, okay, you're approved for $700,000. Okay, that is a pre-approval, and I want to be clear. A pre-approval is not a full approval. Okay, a pre-approval basically says based on the numbers, you will qualify, right? A full approval can only be given once you actually have that piece of real estate in the mix. And so just please be careful again. A lot of people assume that a pre-approval is a guarantee of funding. It is not. And again, you'd want to talk with your mortgage advisor about that and figure out, okay, can I go firm on my offer? Tomorrow night I have to offer on a property. Can I go firm? And you'd have to talk that through with your advisor. Let's say you're approved for $1 million and tomorrow you're offering for $700,000. Well, you know what? Maybe you're in that category of people who we could advise, you know what, you're probably going to be fine, right? But we'd also have to talk about down payments and appraisals and other things. But I just want to clarify, a pre-approval is not a guarantee of approval when you buy. And I can tell you so many times the clients come to us after they went to their bank. The bank said, yep, you're pre-approved, but the bank person didn't explain that they weren't guaranteed, and they've gone back to their bank. The bank somehow has changed their mind for whatever reason. They didn't do their underwriting properly. They didn't ask the right questions, and now suddenly they can't get approved. That is something that we try to avoid. I'm very proud to say that I think our business has more than 335 star Google reviews, and that's because we take a little bit of extra care to make sure that we're giving you the most accurate numbers possible. Okay. The other thing I want to quickly cover is that in the world of mortgage lending, there's two types of interest rates, fixed rates and variable rates. So very briefly, a fixed rate is a rate that will not change during your term of the mortgage. Now, most people take a 5-year term, and let's just say, using round numbers, today fixed rates are at about 4.5%. Variable rates are at about 3%. So there's a 1.5% difference in that the fixed rate is 1.5% more expensive. But that's the price of, I guess, security, knowing that that payment won't change and that rate won't change for 5 years. With a variable rate, those rates can change over the course of, say, your 5-year term. And those rates can change based on the Bank of Canada's decisions. You might have seen lately, this year in particular, the Bank of Canada has raised interest rates, and that has greatly impacted the variable rate. And so if you're in a variable rate already, then your rate will be higher now than it was a couple of months ago. If you were in a fixed rate already, then that rate that you're paying today will be the same as the rate you were paying last year. So there are some costs and benefits to discuss, but just be aware that both are available. And I can't tell you which one you should take until, I guess, we have a more detailed conversation about your particular needs. Okay. Now, in the world of lending, most of you know the major banks, and we work with the major banks. Separate to the major banks, there are about 40 other non-bank lenders, some of which actually have rates better than the bank. And so let me explain this really briefly by giving you an analogy. So, and let me start off by saying these other lenders who are lending you at cheaper rates are usually getting their money from the major banks. Okay, and you might say, okay, why in the world would a major bank be lending money cheaper? So I want you to think about this. I want you to imagine you go shopping at the supermarket for cereal, and you see the cornflakes box that's made by Kellogg's, and that box costs $5, okay? And then a little bit lower on the shelf, you might see a yellow box. It's the no frills box, no name brand. And it's selling for $3, much, much cheaper, right? The interesting thing is if you pick up both of those boxes, you might find that the cornflakes in each of those boxes was manufactured in the same factory. Okay, and the reason for that is that the factory can keep on producing this many cornflakes, but the market will only buy so many fancy boxes at 5%. So, but they still have to sell the others at 5% at $5, but they still have to sell the rest of the cornflakes, and they still make money even if they sell it at $3. Okay, so in the world of lending, it kind of works the same, right? If you want a product in a nice shiny box, we can place you with a lender, and sometimes we have to because they have the right product for you. But if you don't really care so much about the box that it comes in, we might be able to find you a cheaper rate with a bank or a lender that maybe you're not really aware of. But at the end of the day, they're still regulated by the Canadian government and they still have the same requirements. And so many of our clients come to us and we end up putting them with these other lenders who are reputable, but just not as famous as the others. Okay. And then when it comes to choosing a mortgage, it's not just about the rate. Rates are important. We want to get you the best rate, but features are important. The ability to prepay the mortgage, the ability to break the mortgage. Sometimes the cheapest rates in the market have some catches in relation to, oh, you can't pay us back early, you can't pay us anymore, and if you break the mortgage, then there's a massive penalty to pay. So it's again important that you look beyond just the price or the interest rate and look at the details of the type of product that you're getting, so that ultimately you're getting the right product for you. And again, these are the types of conversations that me and my team have every day. Okay, so guys, that is the end of the formal part of this presentation. As I mentioned, this is really for first-time buyers, but if any of you listening have questions around what you've seen here or investing, I'd be happy to sort of open up the microphones right now. If you would like to ask a question, you can type it in the question, sorry, in the chat box, or you can hit that raise hand button at the bottom, and I can click on you and you can talk. So if anybody has any questions, just use those buttons at the bottom, the raise hand or the chat. And I'm just gonna actually unmute Mary, because I know you're sitting with some people.
Hi, Dion.
Hey, Mary.
I do have a question. Yeah.
Yes.
I have a question. Yeah. I know to buy a property nowadays is very expensive. And there are some people who would want to buy a property, their first home, but they couldn't afford. Is it possible for them as first-time home buyers, like there's a group of like 4 people, they will come together, put up a money, like for example, they're buying a home like 700 grand. Can they put up a money, the 4 of them, to buy their first home? My question is, will this be treated as an investment with a 20% down, or will this be treated as a first-time home buyer?
Yeah, that's a good question. So firstly, everybody on the application must be first-time home buyers. So we can't have 3 who are first-time buyers and 1 who is not. Okay, and yes, it will be treated as a first-time buyer application. And so yes, we could do this with the minimal down payment. Around that 5% down payment in that example would be possible. I want to be clear that 4 is the maximum number of people that you can have on an application.
Okay, I do have a follow-up question, Dion.
Yeah.
For example, I don't think they would be able to buy a property in North York, for example, for 600 or 700.
Agreed, yes.
They would, for example, they would decide, I'm going to buy at Thunder Bay because the prices are too low. And 4 people would be able to buy a home of 400. Will this be treated as an investment, or would it be treated as their first home? Because the bank may say, oh, you are in North York, but you're buying a property in Thunder Bay, so this might be treated as an investment.
Yeah, you're exactly correct there, Mary, in that whatever home that we're living in, we need to obviously demonstrate that we can commute to our place of work from there. And so, yeah, in the example you gave, definitely we would not be able to put it forward as a owner-occupied principal residence. Yes.
But they can still go ahead and pool the money and buy, because as opposed to like renting and then not gaining an equity, they can buy a property together even if it's far away.
Yeah, that is correct. So, I mean, I did the same. When I was younger, I wanted to live close to work, but I couldn't afford a home close to work. So what I did was I bought a property that was a couple of hours away from work, but I bought it purely as an investment property with the idea that at least I would have some exposure to the real estate market. And I rented where I lived. So where I lived, I rented, but I had an investment property. And then over the years, that property increased significantly in value. And then when we did want to buy our own home, well, we were fortunate to have savings in the form of equity in that rental property, so that, when we were ready to start our family and we needed to settle down, so to speak, we had enough down payment for the home that we wanted.
So Dion, is this a 5% down payment or 20% down payment?
This would be a 20% down payment.
Okay. Okay, so if, for example, for those who are listening right now, if they're interested, what are the things that they need to prepare?
Well, firstly, I hope you share my email with everybody. In fact, I'll share it here as well. And actually, everybody who has attended today and has registered will get an email after this with our contact details. And in that email that you get, there'll be an invitation for a free consultation call where, we could have a discussion about your situation, your goals, and then in that call, we'll be able to guide you. We might say, okay, you know what? You want to buy at that price, you have that income. Yes, we can probably make that work, and we would move forward with an application. Or if right now you're in a position where it doesn't quite work, we can give you advice as to what you can do regarding maybe savings or discussing with parents or partnering up with others. And then maybe you'll go away with that information and then come back to us in a couple of weeks, having had that opportunity to extend that conversation. So yeah, that would be the next steps. And if we were to move forward, then yes, we would ask for those income documents. We'd send you a link to an application form which you can complete online. The whole process should take maybe 30 minutes, maybe an hour. Okay. And Lydia, I do see your hand up as well, so I'll get to you. Mary, is there anybody else sitting with you who had a question?
Yeah. Anne, you have a question, Anne? Araceli, you have a question?
Can we use our lira for down payment?
Okay, so there's a question here that they're asking if they can use their lira, L-I-R-A.
Yeah, so with a lira, usually it means that it's locked in, right? And because it's locked in my experience, no, the lira, they haven't been able to release that money to you.
Okay, so another question, Dion, because we do have some, like most of our nurses here are unionized. They do have like a pension plan, right, Anne?
Yeah.
Is it possible for them to take out some money from that pool to be invested, or for their first time home buying spree or experience?
Yeah, so I understand the question. We've had the question before, and what we have discovered when we've asked the question to the pension funds is no. Unfortunately, it's for a pension for an income stream for the future, and as such, they're not able to give you a lump sum today in the same way that you'd get it from an Rrsp.
Okay.
Okay. All right, I'm going to answer this question from Gabriel, and then I'm going to move on to Lydia. But yes, let me just answer this question. So Gabriel's asked, okay, this is a good question, and this is the answer may be surprising. So the question is, what's better, a small credit card limit or a large credit card limit? Okay, so let me give you an example. Let's say you have the choice of getting a $5,000 limit or a $10,000 limit. Okay, that's your choice. And let's say that you are carrying a $4,000 balance, or you utilized $4,000 every month, okay? The thing is that the person with the $10,000 limit is only using 40% of their capacity. The person with the $5,000 limit is using 80% of their capacity. Therefore, the person with the higher credit limit will have generally a higher credit score. So the answer is yes, a higher credit limit actually assists in most cases. In most cases. There are some exceptions, but in my experience, that has been the case. All right. Lydia, I'm just going to come to you now. Yeah, go ahead, Lydia, and let us know your question.
Dion, how many times can a person use the RRSP as a first-time home buyer?
Great question. Great question. So, of course, they can use it for the first time, but we have situations where life circumstances happened. Recently, we had a client who was recently separated and had to go and buy their own property, right? Now, the good news is, yes, you can access your RRSPs again, but the rule there is that you can not have been a homeowner for at least 4 years. So in the example that I'm giving, this person they got married a long time ago. They had bought a house. That house had sold like 6 or 7 years ago. Then they were renting for the following 7 years. And then they wanted to buy again. Well, then they could access their RSPs because they had not owned a home for 4 years.
Okay.
Does that help?
Yeah, thank you.
Okay, no problem. Okay, and Esther, I think I see your question here. You mentioned about full-time for at least 2 years. What happened if less than 2 years of employment? Okay, so if you are full-time permanent for less than 2 years, you're fine. Okay, so let's just say you started a job, let's say it had 6 months probation, and now you're in month number 7, you're fine. We can use 100% of your regular income, your base salary, okay? If you're in probation, most lenders will not be able to lend to you. Probation must be finished. But if probation is finished, you are full-time. As long as you've been working there for a couple of months past probation, you're gonna be fine. Or you do not need 2 years. If you are casual or part-time, yes, we will need the 2 years history, okay? And they will use if you worked 18 months as a casual, it's still going to be hard for most lenders to lend to you. They're gonna want to see the 2-year average. Okay. Did you have any other questions around that, Esther? Because you can feel free to talk to me if you like. You can go ahead and unmute if you want, or if you're good, that's fine. We're good. Okay. And then, yeah, back to you, Mary. Is there anybody else that's sitting with you who might have any questions? No, I think we're good. Oh, Lydia, did you have a question?
Yes, the next question is, what are some B lenders you would highly recommend?
Well, there are several B lenders, and just to fill everybody in the world of lending, there are kind of 3 levels of lending: A, B, and private, okay? A is your major banks and 40 other types of lenders that offer really good interest rates. Then we have category 2 or B, which are for people who have less than perfect credit or less than perfect income and can't quite prove what the major banks want to prove. So these lenders are quite common. Many of my clients use them. A lot of self-employed people use them. In terms of like who are the good ones, there are several. But it will also always depend on your your situation, and because they all are a little bit different from each other. So to answer that, like in sort of more detail, we'd actually need I guess a consultation. But there are multiple out there.
So now we've seen that there is Quest Mortgage, and I think Quest is quite new on the market. It's a new lender. What do you think about them?
I'll be honest, I haven't actually heard of them, Lydia. I'd have to do some research on them to figure out what they offer and if what they offer makes sense for you or our clients. But yeah, sometimes clients come to us with the names of lenders, and most of them we know. But if they're super new, oftentimes we don't use lenders who are super new. We like to use lenders who have a good track record of customer service.
Okay, good. So, for example, Manual Life, they are a B lender, I'm assuming, right?
Well, no, this is where I don't want to get too stuck in details here, but Manulife is not a B lender. They're a category A lender. They're just not a bank.
Okay. Thank you. That was helpful. Thank you.
You're welcome. Okay, Esther's asked the question, how high do you recommend about having a high credit limit? So it's going to depend on the credit facility, but I will say to you that $10,000 for most people is fine, as long as you're not spending much more than $5,000 a month on your credit card, which again, for most people is fine. So just do the math for yourself and try and work this out. How much do I spend on my credit card every month? Let's just say the number is $2,000. Then I would want for you to have a limit that's double that, $4,000. That should be the math that each of you do, because if you can demonstrate that you're only using about 50% of your capacity every month, then you're going to be in that better sort of category. Okay, I hope that helps. Okay. I think there's some questions in the Q&A. Yeah, any other questions? No? You know what, guys? There's a question that is sometimes not asked, which I didn't address and I forgot to address. Some people ask, oh, is there any cost to work with a mortgage broker rather than working directly with your bank? And so the answer is no, there is no cost to work with us as long as you end up with a major lender, category A type lender, of which there are like 40. So let's just say that you have the choice of going to, say, Scotiabank directly or going to Scotiabank through me or through my brokerage. Generally speaking, we'll get you the same products as Scotiabank, but in many cases, we'll get you a better interest rate than you as an individual will get at the lender. The reason for that is in this year, you might get one mortgage with that bank. But this year, we'll probably get 1,000+ mortgages with that bank. And like with anything, the more volume you do or the more you buy, the cheaper things get. And so you kind of benefit from the number of mortgages that we do. And we have a bit more negotiating power than an individual would at the bank. And so if you're thinking about getting a mortgage, there's really no loss in working with us. The other thing, the comment we often get is that because all we do is mortgages, that's all we do, our level of customer service that people experience through working with us is commented to be better than the experience of working directly with the bank. And yeah, that's again some questions that are sometimes not asked. If you don't qualify with the regular bank or major Schedule A lender, then we might have to look at those other types of lenders, and there are often fees involved there that range from anywhere from 1% to 3% of the amount of money that you borrow. But in most cases, the vast majority of our clients are just regular clients who will just put with regular lenders, and the banks pay us directly because they don't have to do the work, and we bring them qualified clients and we do all the paperwork on their behalf. Okay. All right. So somebody said that some brokers charge their clients a secret cost. Unfortunately, like with every industry, there are some people that I personally am not very proud to be associated with in the same industry. So yes, buyer beware. You should use people with a good reputation. You should do your own research. Check them out on Google. Check them out on the Better Business Bureau. Make sure that whomever you're working with has a good reputation of following through on what they said they were going to do and not charging you any scary or sneaky fees. Okay. All right. Okay, guys, if there are no other questions, we'll wrap it up now. Mary, is there anybody else on your side?
I think we're good from our side. So Dion, thank you so much. It's very helpful and it's very informative. So yeah, we would like to thank you from every one of us.
Thank you.
You're very welcome. Like I said, everybody's going to get a quick email later today. And if you'd like to take us up on that consultation, we'd be very, very happy to talk with you about what you can do now. And if you can't do anything now, we'd love to help give you a plan so that moving forward, we can help you in the future. Okay, guys, enjoy the rest of your day.
Thank you.
Thank you.
Thank you so
Bye.
much. Okay, bye for now.